Okay, good morning everyone to our lecture today. So lecture number 3, and before I start, let me just very quickly confirm that our midterm will be held on the date that I communicated in the last email. Okay, so that will be the final date. There are no major clashes, so we will use that date. I will give you more information about the midterm closer to the midterm date, but there is nothing to be surprised about. So it will be a very standard midterm, 1 hour, face-to-face. Yeah, everything very standard. Okay? So, any questions from your side about examination, organization, term project, questions, concerns, comments? No. Good. So where are we? We are still talking about this unit 1. So unit 1 is, I don't like calling it an introduction because it's not an introduction in the sense that it leads to the next unit. It's more like providing a background. Okay, it's providing a background about how investment takes place in reality, about many aspects that are quite relevant for real life investment. Okay, so today we will finish unit 1, and then from next week we will become much more theoretical, much more conceptual, more mathematical, because from next week on we will talk about portfolio statistics. And we will also start talking about the first portfolio theory models. Okay, so most importantly, the Markowitz portfolio selection model. Okay? So, but again, now we are still in this unit 1, which we'll finish today. So this is where we stopped last week. We talked about the 2 different ways how we can calculate a stock index. What are the 2 different ways? How can we calculate a stock index? Value weighted and price weighted. Right? So those are the 2 ways. I told you that actually the vast majority of stock indices nowadays are value weighted. Okay? So S&P 500, Hang Seng, I mean most of them are value weighted. There are still a few, including the Dow Jones, that are price weighted. Okay? And actually the last slide of last week, we talked about some special problems that we have if we deal with a price-weighted index. And the special problem was related to stock splits. We said, what happens, or we asked, what happens if a firm splits its stocks? What happens to a price-weighted index? Well, the obvious answer is if there is no adjustment, the price-weighted index will change, right? Because the price-weighted index is nothing else than the average of all prices. So if I do a stock split, and that technically, of course, adjusts my prices, also the price-weighted index will change. Why do firms do stock splits? Or how common is that? It's actually very common. Right? Because firms want to keep their stock prices below certain thresholds typically. Like $1,000 is such a magical threshold. So whenever firms approach that, they often split their shares. The reason is simply that for probably psychological reasons, but also for more economic reasons, it's not so great to have very high stock prices. Because you cannot buy fractions of a stock. So if your stock price is very high, basically you exclude retail investors. Because most retail investors who want to hold a largely or relatively diversified portfolio, they would not invest $20,000 in one single stock. Okay? Yeah, so that's what led us to this question, how can we now deal with the problem? And the problem again being a firm does a stock split, which would technically lead to an index change of a price-weighted index, which is of course nonsense, right? Because It's just a technical adjustment. And then we said we have to introduce this adjustment factor that we call D, so that the index that's artificially stays at the same level. So if we simply divide by 2, so if we simply take the average, the index would change. So we have to divide by the factor D so that the index does not change. All of that is not perfect, so it's not the complete solution, but at least it is a partial solution. Because over time, the index still is affected by stock splits. Okay. So long story short, value-weighted indices solve a lot of these problems and are in economics terms preferable. Okay. What is the problem of value-weighted indices? In reality, what is the problem that they are often facing? Let's say you are a stock exchange operator, you calculate your index. What might be a concern if you use a value-weighted index? Any ideas? What could be a problem? Think about Apple. I mean, we have some corporations that have such a high market value that they basically take up a large share of your index, right? I mean, Apple, 2 trillion. Then we had another few companies. If you remember, I showed you the 10 most valuable companies last week. We have another few companies that have above 1 billion market cap. So those companies take a much bigger role in the index than the smaller ones, obviously. Yeah? Which is to some degree what we want. We want the larger firms to have more impact on our index. But typically we do not want them to completely dominate the index. So what in practice people then do is they introduce caps. So they say that no single share or no single firm can account for more than, let's say, 3 or 4 or 5% of the index. Okay? So the most common approach in practice is value-weighted index with some caps. Good. So these are stock splits. And that is, we didn't talk about that last week. So now we are to some degree zooming in on actual trading, and we think about the different types of orders that an investor can submit, you can submit. The most obvious order is a market order. So if you submit a market order, let's say typically you submit that to your broker, that can be Robinhood or that can be HSBC Bank or whatever. You tell your broker to execute the deal immediately or as fast as possible at whatever the market price is. Okay, so there is no price condition. So basically you tell your broker buy or sell at the best price available. And that's it. And then your broker would try to execute this deal as quickly as possible. And as quickly as possible, that can mean fractions of a second, if we talk about very liquid securities. But that can also mean seconds or even minutes, in the extreme case, even hours, if we talk about less liquid securities. Okay? So this is not the only type of order you can use. You can also use price contingent orders. Price contingent orders instruct your broker to only buy or sell if certain price conditions are met. And the next slide shows you the type of price contingent orders that we have. So we have limit orders and we have stop orders. And this matrix here shows the action, whether you want to buy or sell, and the condition, whether the price is above or below a certain limit. So let's start with the limit orders. A limit buy order, here the illustration, a limit buy order would actually tell your broker, buy the stock, but only if the price is below this limit. So in this case, $133. Why would you submit a limit buy order instead of a market order? What's the advantage? I think it's probably too obvious, right? If you use a limit buy order, you limit the maximum amount of money you have to pay for the stock. If you submit a market order in a bullish market, let's say a small stock, relatively volatile, and the stock is currently going up, you submit a market order. The current market price is 100, but once you submitted the order and all that takes a few seconds, it could be that the price increased to 105, right? The market order would still be executed because you told your broker buy whatever the market price is. So but probably you wouldn't want the stock for 105, you only wanted it for 100. I mean, assume you did your equity research and your valuation model showed that the fair price of the stock would be 102. Right? So you can buy it for 100, that's good, you won't still want it, but if the price goes up to 105, you don't want it anymore. So you can easily solve this situation by submitting a limit buy order specifying 120 cents or whatever. So then the broker would only execute this purchase if the broker can get the share below that price. A limit sell order is probably a bit more tricky to see why you want to use that one. What a limit sell order does is to tell your broker to sell the share if the price is above a certain limit. Sell the share, but only if the price is higher than 142. Okay? And one simple reason why you could use that is that, let's say you are a speculator, kind of day trader type of investor. So you speculate on a specific stock and you think that the fair price is 120, you purchase the stock for 100. So you could purchase the stock now and immediately submit a limit sell order for 120. So as soon as the stock reaches its fair value, according to your calculation, you would sell the stock. Okay? Or you speculate and you say, once I made a profit of 10%, I'm happy, so I want to be out of the stock. So you could you could submit a market order to buy now, and at the same time a limit sell order, so that you already instruct your broker, whenever I have a profit, whenever the stock went above a certain threshold, just get rid of it. Okay? So those are limit orders. The other type of orders we have are stop orders. There is a stop buy order and a stop loss order. Okay? So stop loss order, I think that's pretty obvious, right? Stop loss order not in some sense. Stop loss order is a risk management tool because you instruct your broker to sell the stock when the stock decreases beyond a certain limit. So in this case, $133. Again, quite obvious. Let's say you purchase a stock. Of course, you hope the stock's going up. You purchase for 100. Of course, you hope the stock's going up. But you know it could be that the stock is also going down. So you purchased for 100, but you think the maximum loss you're willing to tolerate on that bet, on that investment, is 20%. So you could submit a market order to buy and immediately also submit a stop sell order or stop loss order at 80. So whenever the price falls below 80, your broker would sell the stock. Okay? So you will never make more than 20% loss. Your loss is capped at 20%. Okay? So that's a stop sell order, stop loss order. What is a stop buy order? Well, the stop buy order is probably the one where it's most tricky to see the use. You instruct your broker to buy the stock if the price is above a certain limit. So if the price is above 142, you instruct your broker to buy. Why? What could be a reason to use a stop buy order? Seems kind of stupid, right? I mean, you say, well, if the price is very high, kind of, then you buy. I mean, that's kind of against the intuition of trading. Yeah? Typically, you want to buy low and sell high. This is the opposite. Why can this still make sense? So probably there are two reasons why that could still make sense. Okay? The first one is a bit of an irrational reason. Some people believe in technical analysis, right? They believe whenever the price reaches a certain critical threshold, then it will go up further or something like that. So if you believe in that as an investor, you could use a stop buy order and once to instruct the broker to buy the stock once the stock breaks a critical threshold. So the technical analysis revealed the critical threshold is 105. And according to your analysis, once it passes 105, it will go further up. So then a stop buy order could make sense. This whole technical analysis is closely linked to the question whether markets are efficient or not, and as I will try to argue, markets are relatively efficient. So the use and the non-use of technical analysis, we will talk about that later. But it doesn't matter now, right? I mean, some people believe in it, so they could use a stop buy order to do that strategy. But a stop buy order can also be a risk management tool. When can we use a stop buy order for risk management? Any ideas? In which scenario would a stop buy order, the instruction to buy if the price is higher than X, actually cut your losses, reduce your risk? Any ideas? Yeah, it's a hedging device, but only in a very specific situation. And the specific situation is that you are a short seller. Right? If you are a short seller, and we will talk about short selling more today, if you're a short seller, what you basically do is you sell the stock without owning the stock. You don't have it, you sell it. So you have -1 stock in your portfolio, right? What you hope is that the price goes down. So at some later point of time, you can buy the stock from the market, close your position. So you have -1 now, you buy the stock later, you have +1, so 0 again. And if the stock price went down, you made a profit. So short selling is a strategy to profit from falling prices. The problem is, of course, if the price goes up, you make a loss. And you can cut this loss, you can limit this loss by using a stop buy order. If you short sold for 100 and immediately also use a stop buy order for 120, you limit your loss to 20%. Right? Because as soon as the stock price goes 120, your broker purchases the stock and your position is closed. Okay? So these are price contingent orders. Something that is also important, but I will have to defer that a little bit, just 2 or 3 slides. Large orders might be filled at multiple prices. So in the next few slides, we will look a bit at market microstructure and how that actually works, and then it will be easier to see what this means. Okay? Good. So how does the trading really work? I mean, typically what you use is a broker, and this broker charges a fee, right? Broker charges a fee, so historically at least. So there is a fee that you pay to your broker for making or for helping you with this transaction, and this is often called the explicit cost of trading. The explicit cost of trading. There is also an implicit cost of trading, which is the difference between the so-called bid and the ask price. So in dealer markets, so in markets where we have a dealer, the dealer quotes a bid and an ask price, and there is a difference between those two, and this difference is actually how the dealer makes money. Okay, but I will show you in a second. So if we look at brokerage commissions now in real life, what actually happened, that at least in the US, the brokerage commission in around late 2019 went down to 0. So now trading basically has no explicit cost for retail investors. And this is a remarkable development because the trading really went down from relatively high levels. Like this is some kind of model trade, I don't know, I think $10,000 investment or something like that. So that the trading costs were as high as $85, and it went down gradually over time, like every 10 years, became lower. And in 2019, it became, for the first time, 0. So this was kind of a big thing. I mean, there was a lot of media coverage. I mean, the death of brokerage fees was 50 years in the making. And this is like a Bloomberg article, and it says, it looks as if 2019 will be remembered as the year when stock brokerage fees finally disappeared. So, and this was led by these, probably you can call them fintech firms. Also, fintech is a very loosely defined term. So Robinhood is one of the ones that became important here. E-Trade, Charles Schwab. Those were the companies that really pushed down the brokerage fees. Okay? So nowadays, if you do trading, there is actually no explicit cost of trading anymore, at least in the US. In other countries, including Hong Kong, it's sometimes still a bit different. But in the US, the brokerage fee is basically gone. That does not mean that trading is completely free, because what you still have is the implicit cost of trading, and this is the so-called bid-ask spread. So the bid-ask spread is the difference between the price at which a dealer is willing to buy and the dealer is willing to sell. So most financial markets, or at least the markets we are looking at now, are dealer markets, and the process is very simple. So basically what happens is you submit your order. Let's use Robinhood as an example because I will use it later. You submit your order to Robinhood. What is Robinhood? Broker or dealer? What's the difference? Broker versus dealer? Yes. Right. The dealer holds inventory. Right? Remember, the real estate agents in Hong Kong, those are brokers. They have no flats. Dealers is the used car dealer who has like the cars on the yard. Okay? Robinhood is a broker. They have no single stock. What Robinhood does is to direct your order to a dealer. So basically Robinhood is just like our real estate agent. Robinhood just helps you to find somebody who has inventory. Robinhood has not. So Robinhood does not get compensation in the form of brokerage fees anymore. That is gone. Then Robinhood directs your order to a dealer, and the dealer quotes a bid and an ask price. Okay? And the bid price are offers to buy, and the ask price are offers to sell. So if you want to buy the security, you have to pay the ask price. And if you want to sell the security, you get the bid price. Okay? Again, Robinhood is only the middleman that just direct you to the market maker. To the dealer. So this is a graphical illustration that was like when Bitcoin was around 100,000. That's the Bitcoin market. What you often see quoted as a price is the so-called mid price. Also, if you go on Google or whatever, what you often find is the price of a stock or Bitcoin or any financial asset, actually, is a so-called mid-market price, which is the average of the bid and the ask price. Okay? This is a super artificial price for which you cannot trade. Actually, this price in reality doesn't exist in the market, because the price that exists is the bid price and the ask price. And the mid-market price is just the average, with actually no economic meaning, because you cannot trade for that price. You can only trade for the bid price, and you can trade for the ask price. Okay? So in this market, the mid-market is 105, sorry, and bid and ask prices are 100,000, whatever, 490 or so, and the ask price are 10,000, and the other price are 100,600. So what that means is that if you want to buy a Bitcoin, you actually have to pay this price, 100,580 or something. And if you want to sell a Bitcoin, you only get 100,490. Right? There is a difference between the bid and the ask price. Okay? And actually this difference is how the dealer makes money. I think it's very logical, right? If you think about a used car dealer, I mean, how do used car dealers make money? Well, if I want to sell a car to them, they probably give me 50,000 Hong Kong dollars. But if you, in the next second, want to buy this car, they charge you a 10% premium. They charge you 55,000 Hong Kong dollars or something. So they have a spread between the price at which they buy and the price at which they sell. And this is exactly the same in financial markets. Okay? So this is the first thing we can see here. There is a spread, the bid-ask spread. The second thing here, and this is why this looks like kind of two mountains, there is a certain quantity behind all these quotes. And I want to show you this with this Bloomberg chart, because I think it's more intuitive to see here. So basically this chart shows you the same thing for a specific stock. I don't know what it is. That's the ticker of the stock, or the Bloomberg ticker. The PowerShares Main Frontier. So these are bid prices and these are ask prices, okay? Here we have bid and here we have ask. The mid-market price would be the average of these two prices. Okay? So what does the bid price now mean? The bid price means, or let's do the ask price. What does the ask price now mean? You can buy shares, these shares, for a price of 24.79. Okay? So the dealer is willing to sell you these shares for this ask price. But there is a certain quantity behind that. This dealer, let's for simplicity assume, only has 100 shares. Or he's only willing to trade 100 shares at this price. So if you buy 10 shares, no problem, you can buy 10 shares for 24.79. 70 shares, yeah, no problem, 70 shares you can buy for 24.79. 110 shares you cannot buy for that price. You can buy the first 100 shares for that price, but the next 10 shares, you have to go to the next ask price, the second most attractive ask price, and for the next 10 shares you pay 24.92. Okay? So that is often not displayed, but if you see a bid and an ask price, there is always a quantity behind it. And this quantity indicates how deep this market is, how easily you can trade large quantities. And some markets are actually not super deep. So if you want to trade large quantities, the currently quoted bid-ask price, that is gone very soon. So that's only valid for a very limited number of shares. Okay? So you see, this is not a very large share, so it's not a very liquid market. Actually, the market liquidity dries up pretty quickly. So here, that's actually phantom quotes, so nobody trades for these prices. So what this also shows you, there are probably 100 plus 30 plus 25512, so let's say there are 140 or not even 140 shares that are actually sellable here. So if you want to buy more than 140 shares, you have a problem. There is no market liquidity anymore. Probably the dealers would kind of find the shares somewhere, but this would take some time. So immediately executable is only an amount of about 145 shares or so. Okay? Behind every bid and ask price, there is a quantity. Of course, for small retail investors, that often doesn't matter, especially if you trade Microsoft or whatever. I mean, if you buy 100 shares of Microsoft, doesn't matter. But for smaller shares and for institutional investors, this is a very important feature of markets, how deep the market is. And actually, that's the reason, we will come back to that in a couple slides, why really large orders are normally not directed to these markets, where we have the dealers, which are often called also market makers, but very large orders of pension funds, insurance companies, they are typically executed in so-called dark pools. Because the liquidity in these markets, for multiple reasons, I will come back to that. So this is a picture I took several years ago in Hong Kong that shows you that this pattern here, bid-ask price, does not only exist in financial markets, it's existing in many different areas, including currency exchange. So this is one of these currency exchanges that at least pre-COVID was very common in Hong Kong. And what they do is also they quote you two prices. They quote a price at which they buy, and they quote a price at which they sell, and the asset, like US dollar. And there is a spread. So what that says is that if you want to buy $1 US, you have to pay 8.38 Hong Kong dollars. And in the next second you sell them the dollar again, you only get 7.04. Okay, so that's how they make money, the spread. And you can see you can make pretty decent money if you have a large spread. I mean, actually you can make a lot of money. Typically, these spreads depend on how liquid the underlying asset is. So for more liquid assets, spreads would be smaller, closer, and also the risk of the underlying asset. So if something is very risky, moving a lot, the dealer wants more compensation. And the reason I will again also show you in a slide or two. It's actually quite surprising how large the spread is for something like the US dollar in Hong Kong because of the peg. I mean, there is virtually no movement in this exchange rate, right? It's fixed. So actually this spread is relatively easy to earn money for the currency exchange because there is no uncertainty in the underlying financial asset, which is not the case, of course, for shares. I mean, shares can move up or down. Good. So these are market makers, and market makers are nothing else than dealers. And these market makers, anytime they quote a bid and an ask price. Okay? So now we see, I mean, that we already said, if you are a buyer, you buy from the you buy here for 100. If you're a seller, you can sell at 99, and this is the spread of $1. Sell at bid and buy from us. What we have here now is the so-called national best bid and national best offer. Okay? And the background here is, but there's a little bit of the details of the microstructure. We have a bit of a problem. Because it's very common that like multiple market makers exist for the same security. Okay? Now you are a broker, let's say you're Robinhood. Okay? You could now have incentives to not send my order. So I'm a retail investor and you are Robinhood. I send you my order and then you direct my order to a market maker. I want you to direct my order to the market maker with the best price. Right? But it could be that you have incentives to use a market maker that is a good friend of yours, who has not the best price. In reality, it's not so much about friendship, it's about money. So I will show you again, sorry for referring to a lot, I will again show you very soon that actually market makers, they pay brokers for orders. This is called the payment for order flow. So in this situation, it could be that you as the broker, you send my order to the market maker that gives you most money, highest payment for order flow, and not to the one that has the most attractive bid or ask price for me. Okay? And to kind of circumvent that or to kind of reduce that, there is a national best bid and a national best offer, which is calculated by the exchange basically. And market makers are required to offer at least these prices or better prices to circumvent this potential issue that they just send it to somebody who gives them a lot of money for very bad bid or ask prices. So this is basically guaranteed minimum price that you get. Okay? In reality, there are also some reasons why that doesn't work perfectly, but that doesn't matter so much now. Okay, so that's the national best bid and national best offer. Basically, the exchange looks at all the market makers, finds the one with the best bid and the best ask price, and that's national best bid, national best offer. Good. So this slide, it's really not so much about the details. I just want to show you a bit the mechanism behind a market maker or a dealer. So how do they make money and what do they actually do? Okay. So we are now a market maker, a dealer. Okay. What is a large dealer, large market maker? I don't know. Choose one. We could be Citadel or something like that. Okay. And we receive orders from brokers. So those are brokers. Charles Schwab, Robinhood, E-Trade. Yeah, that's it. Those are the three we have here. Okay. So the first trade we receive is from the broker Charles Schwab, and there is somebody who wants to sell 100 shares at our bid price. Okay. So they sell 100 shares to us for the current bid, which is 99. Which increases our position by 100. So now we as the market maker, we hold these 100 shares. Remember, we are a dealer. We hold inventory. Okay? So now we have a very lucky situation, and this is actually the dream of every market maker, because in the next millisecond, there is another order coming in from Robinhood, a buy order exactly for 100 shares. So it's exactly the offsetting order. Right? So now at the next millisecond, we sell those 100 shares to the Robinhood customer. We have 0 shares, 0 exposure, and we made a profit of 100. Bid ask spread $1 times 100 shares. That's perfect. I mean, we as the market maker, we love that. We have no exposure to the actual underlying security, to the price movements, and we still make good money. So this trade seems riskless, right? I mean, 1 millisecond you get it, next millisecond you sell it, you get the spread. But of course, unfortunately for the market makers, that's not the reality. Right? In reality, different orders do not offset each other perfectly. So this is what is explained here in the second part. So we have a buy order for 210 shares, a sell order for 273 shares, and then 2 more buy orders for 420 shares in total. So more brokers direct buy order to us than sell orders. So actually we have short position in the underlying share because a lot of people bought from us. And only a few people, those here, they sold to us. So our position in the share became minus 357. Okay? Which is not good. Because now we have a position in the share. We have a value, we have an exposure to the share. And what happens now is that the share price moves. the share price just goes up $1. Okay? The share price goes up $1, and we have a negative position. So now, luckily, and this is how this example is designed, obviously, somebody wants to sell us 357 shares. Okay, so this is exactly offsetting our position here. The problem is that they are selling us for the new national best bid of 175, which is now much higher. So we have to pay a price of 175 now, because the overall market price went up. So overall, in this example, we made a loss of 357 with these deals, and the total loss is 120. So don't get confused. This is really a simple example. 2 points are very important. If the market maker has exactly offsetting deals, I mean, everything's fine, right? I mean, the market maker earns the spread and is happy. But if the deals are not perfectly offsetting each other, then the market maker builds a position in the share that is positive or could also be negative and exposes the market maker to price risk. Because now if the underlying share moves, the market maker can gain or lose. It's like speculation. Right? I mean, if it goes the other way, the market maker would win here. Okay? So the basic business of a market maker is really earning money from the spread. So they want to avoid these positions. So whenever they see they're building up a large position in a specific share, they try to find offsetting deals. Okay? So that their position in a specific share does not become too high. Clear? Good. So and this kind of also shows or illustrates why the spread must be larger for more volatile shares, right? Because if a share is more volatile and you have a position in the share, you are more exposed to price risk, and you as a dealer / market maker, you want to get more compensation for taking that risk. So you have to earn a higher bid-ask spread to compensate you for that risk, or otherwise you would not be in that market. You would just say, oh, this stock is so risky, I can only earn a tiny bid-ask spread, I'm not offering this stock. I mean, market makers are private firms. They can decide whether they want to offer their services or not. Okay? So more volatile shares tend to have higher spreads because of that. Good. So, is that clear? Confusing? Clear? I think the picture can be a bit confusing, yeah, but if you look at it carefully, you will see it's actually very simple. And again, those two messages, perfectly offsetting deals, ideal situation for the market maker, they just make money. But in reality, they can get a positive or negative position, and then they are exposed to price risk. So, one step back, we're now looking again at the broker. We're looking at our Robinhood friends. So, Robinhood does not get brokerage fees. Now remember, we said brokerage fees went down to 0. So basically, if you use your Robinhood app, you can trade for free. No explicit cost of trading. Okay. So how does Robinhood then make money? I mean, they must make some money, right? And their largest income is actually from something that is called payment for order flows. Payment for order flows means that the market maker, like Citadel or Wolverine, they pay money to the broker for sending them orders. Okay? So this is for one specific quarter, Q4 2020, and these are $1 million US. So Robinhood received around $200 million US from Citadel for sending orders from Robinhood to Citadel. Okay, so but not only Robinhood, also other brokers, of course. So these payment for order flows is a compensation that a broker receives for directing orders to a market maker. There are some legally regulated limits. As I said, there are also some other regulations about that. For example, you have to get at least the national best bid or best offer price. You cannot just send it to any market maker that offers any arbitrary price. It must be at least national best bid or offer. Okay. It's still controversial. It's like a kickback, and there are potential conflicts of interest, of course, especially because this national best bid offer price also works only so-so, because these are the published prices, but often market makers have also private prices that they only tell the brokers. So what you see published as the national best bid and best offer is not necessarily the truth. Okay, so that, in other words, there could be ways to kind of manipulate this national best bid, best offer. I'm not saying they're doing it, but there could be ways. So people have concerns about those payment for order flows, but it's there, it's big. It has some potential advantages. It could lead to price improvement for consumers. So the fact that we are seeing 0 brokerage fees is directly related to that. So without payment for order flows, Robinhood would not be able to offer you 0 commission trading, and Charles Schwab and all the others too. So it has potentially some price advantages for consumers, and it can also be quite helpful for the market makers. This is why some people argue it could create higher liquidity and attract more market makers, because market makers can use payment for order flows for 2 purposes. First, they just can use it to grow. Right? I mean, if I have a lot of payment for order flows and I pay Robinhood a lot of money, Robinhood sends more orders to me and I can grow. That's the kind of obvious reason. But there is also a less obvious use of payment for order flows, and that is that market makers, like remember this position here, we really have a problem. We have a short position of 357 shares. So what we could do now is we could say to the brokers, look, we really need people selling us shares, so we will pay you high compensation for buy orders. So in that sense, you could use payment for order flows to attract specific types of trades that you want, that you need to balance your position. Right? If you need buy orders to balance your position, you offer a lot of payment for order flows for buy orders. If you need sell orders, the other way around. So theoretically, you could use these payment for order flows to attract specific types of deals that you need to balance your position. Which then can reduce the risk of the market maker, because it's easier for the market maker to get a lower exposure to price risk, and that can then reduce the bid-ask spread, because lower risk, lower compensation. So there are channels how payment for order flows could lead to higher liquidity, and more obvious channels how it can improve prices for consumers. Good. So let me just show you some numbers. I think they are kind of interesting. So this is actually the annual report, the 10K of Robinhood. This is 2019, 2020, 21. So these are the revenues of Robinhood. Okay. If you look at the types of revenues they have, there are basically 3 types: transaction-based revenues, net interest revenues, and other revenues. If you look at their importance, I mean, transaction-based revenues are by far the most important. So what are transaction-based revenues? They consist of amounts earned from routing customer orders for blah blah to market makers. When customers place orders, we route these orders to market makers and we receive consideration from those market makers. So this is exactly what I just said. This is payment for order flows. The market maker pays their money. And this is by far the largest income source or revenue source of Robinhood. By far. So, interest revenues, I will show you in a second. This is related to buying on margin. So buying on margin, we will talk about that after the break, means that you use a loan from your broker to actually buy shares, not only with your equity, but also with a loan. And for this loan, the broker will receive interest. And this is basically here net interest revenues. Okay. And other revenues, yeah, I think they have kind of a gold membership where you can pay them money and then you become a gold member or whatever. Doesn't matter so much. So this is another illustration. So this is Robinhood revenue in only one specific quarter, Q1 21. So these are 520 million. By the way, I mean the 520 million total revenue and transaction-based revenue 420 million. So pretty insignificant. 420 million, and on a yearly basis, 1.4 billion transactions. So these are billions. 1.4 billion transaction-based revenues for Robinhood. And if you look at where they are coming from, most of them actually come from option trading. So option trading is most profitable for Robinhood. But equities is also important, and crypto is super important. I mean, crypto only accounts for a relatively small share, but these guys make crazy money in crypto trading. Okay, and it's also probably, at least at that time, it was the fastest growing. And net interest, a lot of that comes from the securities lending. This is actually buying on margin. Yeah, Robinhood is still not really profitable, as you can see here, but that's not the point here. The point is most of their revenue comes from payment for order. Yeah, so this is just an overview how payment for order flows changed over time. So actually that was not a really big thing like 10 years ago or so, only 400 million. It became really big when those more fintech-y companies entered the market. So when Robinhood especially entered the market or became much larger. So that was like in 18, 19, and in 2020 it exploded. So it exploded from around 1 billion in 2019 to 2.5 billion in 2020. And the trend is continuing and going upwards. So payment for order flows, very big. Very, very relevant now. It's basically the business model of many firms, brokerage firms, is now based on payment for order flows. Okay, let's do the first break now, 10 minutes, and then we continue. Okay. Sorry. So let us continue. So this is payment for order flows. So relatively recent phenomenon that is becoming more and more important. And if you ever wondered why you now can trade freely on Robinhood and other platforms, I mean, actually this is the reason. Okay. So any questions about that? No questions. Good, let's move on. Buying on margin. So what is buying on margin? I mean, the traditional way how you buy equity is to use your own money, right, and invest your own money. So let's say you have 1,000 Hong Kong dollars, you buy your shares, for 1,000 Hong Kong dollars, and the shares go up 10%. I mean, how much do you gain? 100, right? 10%. The shares go up 10%, you go in 10%. So we call this your exposure or your delta, your sensitivity to the stock price movement is 1. If you buy all equity, the sensitivity to the stock price movement is 1. So an alternative could be that you do not only use your equity, but you also borrow some money to purchase shares. But let's do the same example. Let's say you buy shares for 1,000, but you only use 500 equity and 500 debt. Okay? So again, the shares go up 10%, so they end up at 1,100. You have to repay your loan of 500. So you basically have now 600 and you only invested 500. So how much money did you make? You made 100, 600 minus 500, for an investment of 500. So you made 20% relative return. So what we call this is you levered up your position. You increased your exposure, your sensitivity, your delta. So you have a delta of 2 now, because you did not only use equity, but you also use debt to purchase the stocks. Okay? And there is nothing really fancy about that. I mean, there is another situation where this is very common, and this is the market for real estate. But if people buy apartments in Hong Kong, they typically do not only use equity, they use equity and debt. So actually, if the housing price goes up, they gain more than the increase in housing price because they have a levered position. If the housing price goes up 5% and you purchase your apartment with 50 equity, 50 debt, housing price goes up 5%, you actually gain 10% on your equity. Right? So there is nothing, that's basically buying on margin using debt and equity to increase your sensitivity to the stock price movements. I mean, obviously, I think it goes without saying, I mean, this is not a one-way street, right? I mean, you increase your sensitivity to positive price movements, but also to negative price movements. In other words, you gain more if the stock, the real estate market go up, but also you lose more if it goes in the other direction. So one very common way to realize these purchases with equity plus debt are these brokerage loans. So you can have a loan from your broker, and then you use the loan from the broker and your equity to purchase the share. Okay? Conceptually, in economic terms, there is no difference between a loan from your broker, or you could also go to your bank and just ask them for a loan. I mean, economically, that just makes no difference. Okay? Still, most people do it on the brokerage platform because it's very simple and because the broker keeps your portfolio, the stock that you purchase, as the collateral, which basically makes this loan risk-free or close to risk-free for the broker, because the broker always has the stock that you purchase via your broker on the brokerage account as the collateral. And let's say you have a loan from your broker and you cannot repay, or you flee to the Bahama Islands or whatever and nobody heard of you ever again. The broker is actually not panicking because he's simply closing your account, selling your shares, taking his money, and that's it. It's very risk-free for the broker. That's why actually everybody can have such most people can do buying on margin. You don't need to go through credit score evaluation or something like that. It's always collateralized. So there is a margin, and margin is defined as the percentage that is contributed by the investor. So there are some legal regulations. So the initial margin is typically set to 50%, which means that you cannot use more than 50% debt to purchase these stocks. Right? I mean, the idea is very simple. If you would use too much debt and too little equity, then this would be risky again for the broker. And let's say in an extreme case, you have a stock that you purchase with 100% debt, no equity. But the stock price today is 100. You use 100% debt. So you use 100 debt. And now the stock price goes down to 99. So now your loan is already under collateralized because your loan is still at 100, but the value of your stock is only 99. So now your broker is very concerned. So this situation can never happen because we require that there is always a certain percentage of equity which acts as a buffer. Okay? The initial margin is typically set at 50%. So if the share price is 100, 50% can be financed via debt, 50 and 50 from equity. But of course, over time, this margin can change because let's say if the stock price goes down, what happens is that your loan value stays the same. You still have 50 that you owe to the broker, so your equity goes down. So stock price goes down from 100 to 80. Your loan is still 50, but now your equity is only 30. And now it goes down even further to 60. Your loan is still 50, but now your equity is only 10. So if it would go to 50, actually the value of the stocks would be exactly the value of the loan. So to avoid such situations, to avoid the risk that really the value of the stock becomes lower than the loan, there is a maintenance margin, and whenever your equity ratio falls below a certain threshold, actually your broker will call you or inform you that you have to transfer new equity, which is called a margin call, or otherwise the broker will close your account or close your position in that stock. Okay? So this is like trivial, whatever, but let's still do an example. Let's say the share price is 100, the initial margin is set to 60%, maintenance margin 30%. You purchase 100 shares. So your position on your brokerage account has a value of 10,000, so 100 shares times 100. You use 4,000 loan and 6,000 equity. So this is how we set it up. So over time, the stock price changes. So in this case, unfortunately, the stock price went down. So the new position in the stock is not 10,000 anymore, it's now only 7,000. And the important thing we have to see here is that, of course, the loan didn't change. Right? I mean, it's a loan. I mean, the broker doesn't care if you make profit or loss in the sense. He always wants the 4,000 back. It's a loan. So 4,000 stays the same. So what changed, obviously, is your equity, which is the difference between the value of the stocks and the loan. So your equity went down to 3,000. So your margin, equity divided by the value of the position, is now only 43% and not 50% as it was in the start. Okay? Clear? So 43% is still higher than the maintenance margin of 30%. So in this situation, stock price falls to 70, actually nothing would happen. You're probably unhappy because you lost money, but your broker would still be very relaxed because your broker knows that the value of your stocks is 7,000, the value of the loan is only 4,000, so it's still more than enough to cover your loan. It's still over-collateralized. Okay? So how far can the stock price fall before you receive a margin call? We said that the maintenance margin is 30%, so we basically use this formula. So equity divided by the value of your position and set this to 0.3 to calculate the stock price at which you would get a margin call. Okay, so again, it's very simple. This is the value of your equity, right? 100 times the price is the value of your portfolio minus the loan scaled by the value of the portfolio. This is the margin. This margin equals 0.3 if the price is 57.14. So if the price would fall below 57.14, your margin would go below 30%, and your broker would call you and tell you, look, my friend, your margin is now below the maintenance margin, so please transfer ASAP new equity. Okay? And then you probably have a couple hours to transfer new equity, bring the margin up again, or the broker will sell the stocks. Okay? So that's the very simple way how this works. So in reality, of course, this maintenance margin and the risk for the broker will depend a lot on the riskiness of the stock, right? Because if the stock is very risky, there is a lot of volatility in the stock, the broker would set the maintenance margin relatively high. Because imagine you have a very small stock where it can be that overnight the stock drops 50%. I mean, that suddenly then exposes the broker to risk if the value of your position can drop 50% overnight. If this is Microsoft, I mean, the probability that the stock of Microsoft overnight or within a very short time period drops by 50% is probably close to zero. Okay? So how high the margin is will depend a lot on the riskiness of the underlying stock. And again, why do we need the margin? Well, we need the margin so that the brokerage loan is always over-collateralized. Over-collateralized simply means the collateral, the stocks, have a higher value than the loan repayment. Okay? So, a simple example, a little bit more realistic now, because obviously the broker would not give you this loan for free. The broker would charge you interest on the loan. So you have to pay interest to the broker. So we assume now that we have an investor who buys 20,000 worth of stock. The investor borrows 10,000 from the broker, and the interest rate is 9% per year. Okay? So relatively high, 9% per year, and I will show you in a second if that is realistic or not, or how that compares to reality, to practice. Yeah, so value of the stocks 20,000. And then we look what actually happens after 1 year. So for the case that the stock price did not change, I mean, after 1 year, the repayment of the loan is 10,000 plus the interest is 900. Remember, we have 20,000 stock, 50-50. So the loan is 10,000 plus 900 interest. So we repay 10,900. What is our profit? Well, we end up with an equity of 9,100. 20,000 minus 10,900. So we have 9,100 equity at the end. We started with 10,000 equity. So we lost 900 of 10,000, which is equivalent to a 9% rate of return, minus 9%. Okay? So what you see here, I think also not surprisingly, in realistic examples with interest rates, if the stock doesn't move, you lose if you buy on margin. So if you buy on margin, you need some upward movement to at least earn your interest. If the stock is flat, buying on margin is a bad idea. If the stock moved up, I think, I mean, it's pretty obvious, right? 30% increase, so your value increased to 26,000. The repayment of the loan and interest is still the same. That does not depend on the stock price development. So now you get a return of 5,100, so 10,000. 15, your equity position is 26,000 minus 10,900. So 15,100 minus your 10,000 original equity. So you made 5,100 profit for an investment of 10,000. So the rate of return is plus 51%. Okay? Yeah, and for decrease, I mean, you can do the math by yourself. It's exactly the same. It went down to 14,000. So your equity it's 3,100. So that is equivalent to a loss of 69%. So what you see here is the delta, the higher sensitivity of your value position to the stock price. If the stock goes up 30%, you make 51% profit. If the stock goes down 30%, you lose 69%. So basically you have a delta of 2, but additionally you have to subtract the 9% interest rate. So buying on margin is very risky, and you can increase your exposure to the stock, your sensitivity to the stock price movement, but always remember that this goes in both directions. You are more sensitive to upward movements, so in other words, if your bet turns out to be right, that's great. But you're also more sensitive to downward movements. Okay, so far so good. I mean, is that something that is relevant in practice? And the answer is yes. So this is, again, from the Robinhood website. Basically, it says to purchase a margin, you're required to have at least $2,000 on your account. But if you are flagged as a day trader, you must have even more. So Robinhood allows buying on margin in certain limits, and you are required to hold certain deposits, basically to mitigate their risk and to make sure you're always over-collateralized. But you can do it. So even retail investors on the Robinhood platform can quite easily buy stocks on margin. So that's why actually buying on margin is pretty common. Everybody can do it. It's not something that only a selected group of people can do. It's not something for which you need a high credit score or something. Basically, everybody can do it. Okay? So is that expensive? Yes. Very expensive, actually. So this is, again, from Robinhood. And Robinhood charges a standard margin interest rate of 11.25%. So, I mean, think about it. 11.25% for a loan that is always over-collateralized. So basically for Robinhood, there is close to zero risk in that because they always have your stocks as collateral. So 11.25% seems pretty high. Yeah, if you're a gold customer, actually, then it goes down to 7.25%. But for most customers, they charge 11.25%, which explains why this interest income is also part of their revenue and an important, actually, source of income. So, long story short, margin buying on margin common, possible in practice. You increase your risk up and down. All right. Questions so far? Good. So far, when we talk about the stock trading, we talked about the brokers and the market makers. So basically, most of these deals, at least how we should think about them, are executed on organized exchanges. So basically, the organized exchange, like the Hong Kong Stock Exchange, they operate an electronic platform, and via this electronic platform, the brokers and dealers, they can basically trade. Okay? This is not the whole market. There is also another market that is called over-the-counter market, and in this over-the-counter markets, there is no such thing as a central trading location. There is no central clearing. It's very common that you have multiple market makers with often very different bid and ask prices at the same time. And it's not even very transparent. There is not a national best bid or national best offer like in organized exchanges. It's just basically you have to call different market makers to ask for their prices. Sometimes you can use computer systems to look up for their prices, but it's not as transparent as an organized exchange. Okay? So quite different to organized exchanges. And there are some stocks that are traded only on over-the-counter markets and not on exchanges. Okay? So these stocks are typically small firm stocks, often penny stocks, and very often risky. And if I say risky, I mean very risky. Okay? OTC markets are still probably a good thing. But if we look at it from an investor's perspective, we should really know what we are doing. The reason why firms trade OTC and not on organized exchanges is that it is much cheaper to trade OTC because you do not have a lot of reporting requirements. So basically that's the Wild West. There is no reporting requirement or not a lot of reporting requirements. It's not like trading at the New York Stock Exchange. There you have to file quarterly financial reports and everything. OTC, close to zero regulations. And I show you now an example of what can happen, or what frequently happens with over-the-counter trading. So this is a stock. It's called Blues Fair. I think nobody has ever heard of that. It was a penny stock for most of its life, actually. So this is time here. This is 2020. Basically a penny stock hovering around $0.00001 or so. Very, very little movement. And this is the trading volume of trading. So you see basically no trading. And then suddenly, somewhere in December or early December 2020, some interest starts to build up in this stock. Some people start trading this stock. But prices are still relatively low. And then in January 21, suddenly the price jumps. And in absolute terms, it's not a big jump. I mean, it's only 3 pence, $0.03. But in relative terms, it was like a couple thousand %. Okay? So what happened? Did Blues Fair just invent a magic product that made them a very prominent firm? Actually, no. What happened was something like this. Many investors on investment platforms, Reddit, StockWits, something like that, suddenly start talking about Blues Fair. Tweets like, that's not a tweet, but yeah, probably that's even a tweet. Blues Fair can't sleep, you guys still awake. And they just start using this hashtag kind of thing and always use the stock ticker, and they start talking about it. So especially people who have large networks suddenly start talking about this Blues Fair stock. And then this is another example, Blues Fair getting so much steam. So then over time, actually what happens that is an investor started really looking into that and getting interested. And this is another example, Blues Fair will be in Pennyland very soon. Get in or regret not getting it. Yeah, so these were the kinds of messages that were floating around. And then a lot of people actually thought, oh, they might know something. Let's buy this stock. A lot of people invested in this stock. And then what's also quite typical, and this is a couple months later actually, this is January 19, some people started to ask very basic questions, like this guy here. I can't find any real information. Company's website has financial back to 2018. Any leads someone can recommend. Thanks in advance. Basically, there was no information about the company. It was a complete black box. Nothing. No financials. It's not even totally clear what this company does. But still, the investors pushed up the price. Or the small retail investors started to jump on that rumors and pushed up the price. Okay? So was that a long-term success story? Not really. If you look at the price, it actually went up quickly and crashed quickly again. So this is a very nice example of something that is sometimes called a pump and dump scheme. So some people, I mean, the idea is very simple. You buy stocks when they are super cheap, and then you try to generate interest in the stock so that other people also buy the stock. Basically, that at some point becomes like a self-fulfilling prophecy because more people buy the stock, so the price goes up, more people get interested, so more people buy the stock, price goes up further, and you see those spikes. But at some point, people start asking, well, what is this company actually doing? And then they start selling again, and then it crashes. So basically, who really made a lot of money are those guys who purchased the stock at very low prices here and sold them here. But a lot of other people lost a lot of money. If you purchase here, I mean, basically you lost all your investment. So I'm not interested in Blue Sphere per se. I'm just showing you this example to highlight the risk in OTC trading. So I'm not saying that there cannot be great investments. There surely are in the OTC markets, but it's very risky. And a lot of that it's very intransparent, very opaque. Okay? So we need to be very careful when we do that. OTC markets by themselves, they surely fulfill an important role in the markets, right? Because especially after Enron and this crisis in the early 2000s with 2004, the US enacted the Sarbanes-Oxley Act. And the Sarbanes-Oxley Act made it actually very expensive for firms to be public corporations. Very many reporting requirements, risk management requirements. So for a lot of smaller firms, it's just not possible anymore to be listed at an organized exchange. And for those firms, OTC markets offer a nice alternative. So OTC markets are not bad. This fact that there is a lot of fraud and questionable trading practices going on just highlights how careful we should be about these markets, but these markets still fulfill an important role. Good. I quickly talked about dark pools before. So now we talked about OTC markets. Now the next place, we talked about organized exchanges. Now we talked about OTC markets. Now let's talk about dark pools. Okay, so that's another type of market where trading can take place. And actually in the US, a lot of trading is taking place in dark pools. There are some estimates I will show you in a second. That's around 50% of all the trading in the US is nowadays on dark pools. Okay? So what are dark pools? It's actually electronic trading systems that directly link institutional investors with each other. So there is no real central clearing or something like that. Basically, it's just a network that allows one institutional investor, one pension fund, to directly trade with another institutional investor without any middleman. Okay? This is very attractive for large orders, for institutional investors who want to buy or sell large quantities. First, because the prices can be pretty cheap. You have no middleman, you have no exchange, you have no market maker, nobody wants to earn money. Right? I mean, you want to sell, another institutional investor wants to buy, so you directly trade. You completely eliminate all the costs for the middleman. No broker, no market maker, nothing. Much cheaper. But it's not only about the cost. It's also very intransparent. It's very opaque. Which is, for these guys, pension funds, mutual funds, high-frequency traders, hedge funds, something that they appreciate. Because what their problem is that often, if they trade large quantities, they move the market a lot. And that is something they don't want, right? If you are a hedge fund and you want to build up a position in a certain stock, you don't want to move the market up because then you have to purchase for higher and higher prices. Okay? You move the market up because if investors realize that a large hedge fund is building a position on a specific stock, a lot of traders will mimic your strategy. They think, oh, this hedge fund, those are clever guys. Like, you think about what Hindenburg did. I mean, if they realize Hindenburg is building up short positions on some stock, I mean, you can easily mimic their strategy by also building or buying put options or whatever. So that's why they often prefer to do the deals in the dark pools. And this is really the dark in the name, because it's not transparent. They directly trade with another institutional investors. They basically agree not to tell anybody. So the market doesn't really realize what's happening. There is no central clearing. There is no exchange. There are no numbers that are published. It's just one large guy trading with another large guy. Bilateral deal, nothing communicated. So nobody's involved except for those two parties. So that's why it's very cheap and very intransparent. Okay. Yeah, and this is something that they appreciate. Not only hedge funds, also pension funds, other large institutional investors, insurance companies, also mutual funds, because you can also think about mutual funds, right? I mean, if investors realize some actively managed mutual funds are overweighting a specific stock, I mean, they might mimic their strategy and then push prices up. But the institutional investor doesn't like that because they want to buy at a lower price. Good. And this market is really separated from the organized exchanges. You really have to think about it in easiest terms as like completely different market. It's not using the servers of the New York Stock Exchange, for example. It's just separated from that. These dark pools actually became quite important in the US, to some degree also in Europe. Not so much for some reason in Asia. So this here is not so important. I mean, there is now more people trying to build up dark pools also in the Asia area, because like what this says here is dark trading in Asia is still relatively minimal compared to the US, because in Hong Kong, dark pool trading only accounted for something like 1.5% of the overall market turnover. If you compare the volumes on dark pools to the turnover of the Hong Kong Stock Exchange, it's only 1.5%. But all these numbers, we have to be a bit careful because that's all estimated. Look, the name dark pool suggests it's dark. I mean, we don't know exactly how much is traded. This is just like an approximation. But if you do these approximations for Europe, it's roughly 10%. And if you do it for the US, it's somewhere up to 50%. So dark pools are clearly very important in the US. They are somewhat important in Europe. And in Asia, they might become more important in the future. But still, especially in Hong Kong, not yet very important. Okay? Good. Yeah, high frequency trading. So this, we talked about the marketplaces. Now let's talk about how people trade. And one specific form of trading is high frequency trading. Okay, high frequency trading. Sometimes people understand slightly different things under the term high frequency trading. So the definition here, I think, is actually not bad. High frequency trading is the use of a highly computerized trading mechanisms such as fast computer algorithms and live feeds of financial data to decide what and when to buy or sell. Okay. If we talk about high frequency trading, we are really talking about very high speeds, very high frequencies. Okay. So over the years, actually the time it takes to execute orders decreased a lot. So what you see here is time. So those are years 2009 to 2014. And this is the time it takes in order to move from New York to Chicago. That was around 16 milliseconds in 2009. And that time was reduced to 8 milliseconds in 2014. And since then it has been further reduced. So it's really, really, really blazing fast. And if we talk about high frequency trading nowadays, people often don't use milliseconds anymore, they use microseconds to really talk about speed. Okay? So it's very fast, it's very high frequency, you buy and sell a lot, which has a lot of implications for the markets. Actually, it creates a lot of stress also on the market. I want to show you this video clip. You can watch the first 3 minutes or so. I think it's interesting because it shows what high-frequency trading actually does, and it also goes a little bit into the pros and cons of high-frequency trading. Unfortunately, we will not have the time to really discuss high-frequency trading advantages, disadvantages in a great level of detail, but I want to touch a few things that I think are important to know.
This is what the stock market was once like. A large room with monitors on the wall, showing continually changing columns of numbers. On the floor, a hectic crowd of traders and a babble of voices, from which one repeatedly heard the shouts, "Buy" and "Sell." But this picture has changed. The room is still there, along with the monitors, but the crowd has become much smaller. Quietly humming computers have taken their place. The traders who monitor and control the computers are either sitting at home or in the office. These computers work much faster, never go on holiday, and rarely require a person to run them. These computers are equipped with trading programs based on mathematical formulas known as algorithms. Instead of the traders, it is these programs that evaluate stock market rates and are able to buy and sell stocks either fully or semi-automatically. Some of these trading programs only perform simple commands. For example, when the price of grain falls below a certain value, then buy X number of grain stocks. Other programs can follow several commands at once and are relatively complicated. But they are nothing compared to custom-built, high-frequency trading computers. The trading programs installed on these computers can independently pursue complex strategies with incredible speed. These programs compete with and battle one another. To ensure they don't run the risk of losing, they always have to be faster, more flexible, and more independent. What was previously traded within days, hours, and minutes is now bought and sold within seconds, milliseconds, and microseconds. High-frequency traders only account for a small part of all traders, yet are responsible for about 2/3 of all stock market transactions. The high-frequency trader's basic strategy is very simple. Trade as much and as quickly as possible. The profit margin on each transaction is frequently quite small, but these small amounts add up to billions due to mass and velocity. To make this work, the high-frequency trading programs must always be a split second faster than the others. And that's only possible when they are close to the stock market. The shorter the cable, the faster the information can be transmitted. It's all about milliseconds. For example, the buying price of a certain commodity rises minimally. Since the high-frequency trading programs can process this information before other trading programs, they have the opportunity to be the first to respond to the price trend. Before the trend ends, the commodity stocks are sold again at a minimum profit per share. High-frequency trading may have advantages and disadvantages for the markets. Many market researchers believe that high-frequency trading increases so-called liquidity. A market has a high level of liquidity when a trading partner can be found for every offer. However, high-frequency traders work especially well in markets that are already highly liquid. What's more, they are not obliged to always act as trading partners. In a crisis situation, when they are most required, high-frequency traders pull back from the market and this benefit is lost. Some also think that high-frequency trading facilitates pricing while reducing price volatility. However, these assertions are highly controversial, as some high-frequency trading mechanisms have the opposite effect. Disadvantages include the fact that normal traders cannot match the speed of the high-frequency traders, because firstly, not everyone can afford to rent space close to the market, and secondly, they cannot always pay for the specially programmed high-frequency trading algorithms. Due to more direct proximity to the stock market, the high-frequency traders have a clear information edge. This means that all classic dealers lose out to high-frequency trading. Effectively, every classic trader not only pays the explicit exchange fees, but also an implicit fee for high-frequency trading, because this type of trading is interposed between most stock market transactions. Another drawback is that the novel high speed and the lack of regulation are often exploited by high-frequency traders to manipulate the markets and deceive other market participants. One example here, it is difficult and costly to continually stay one step ahead. Instead, it is easier to slow down all other market participants. This happens through so-called quote stuffing. In this scenario, a trading program makes thousands of small, unimportant offers, thereby producing a flood of information. In filtering out the unimportant information, other programs lose valuable milliseconds and respond too late to the interesting offers. Another manipulation technique is called spoofing. For example, a trading program will generate a number of overpriced purchase offers. Thanks to the extreme speed, these overpriced offers can be canceled immediately before anyone purchases them. But as these phantom offers are nevertheless seen, this creates the illusion that a number of dealers are interested in buying the offers, and that prices for these goods will soon rise significantly. Other traders react to this illusion, ensuring that the price actually does rise. The spoofer can now use previously acquired options bought at an unmanipulated price to make significant profits. Computer-controlled.
Okay, so that's enough, I think. So, yeah, it's a very complex topic. So there are different trading strategies for high-frequency trading, and there is a lively discussion about pros and cons. Let me, before we take the second break, just show you a few quick numbers. First, actually, the share of high-frequency trading is not increasing anymore. So it probably reached its peak around 2009. So this in red is the shares, the fraction of shares in the US that were traded by high-frequency traders. So that reached its peak around 60% in 2009 and was relatively stable around 50% since then. In Europe it's lower, but the time patterns is kind of similar. Okay? So why has it stabilized around 50%? Well, one explanation is that actually in this time period when the share of high-frequency trading increased so much from, let's say, 2000 to 2009, that was kind of the Wild West of high-frequency trading. There was very little regulation. The regulators have not yet adjusted to these high-speed trading tactics and strategies, so they were really bad, actually at detecting manipulation and stuff like that. So you could, I mean, it's a bit exaggerated, but you could, in a sense, do whatever you want, at least at the beginning, because it was so novel. And that meant that, like, in this time, this is the revenue of high-frequency trading. These guys really made a lot of profits. Very little regulation, not a lot of competition, because that was the beginning of high-frequency trading. So these guys made a lot of profits. But then, over time, actually, people or more firms realized there was a lot of money to make in this market. They also entered the high-frequency trading market, and that was pushing revenues and profits down. So now high-frequency trading became a more mature industry with more competition, more regulation, which made it less profitable. Okay, so that's one explanation why actually the share of high-frequency trading stabilized around like 50%. Okay. So the video talked a bit about pros and cons. Yeah, it's a difficult discussion. I mean, liquidity is often mentioned as a potential advantage, but then, as the video says, other people claim that, look, in times of crisis, like high-frequency traders are the first to basically leave the market, so they are not really providing liquidity when liquidity is really needed. Narrower spreads, so probably more liquidity, a lot of discussion. Probably also higher prices because of this high-frequency trading markup. So basically what happens if you trade, you often have like high-frequency trading interposed because the high-frequency traders first buy the stock from somewhere else and then they sell it for a slightly higher price. And this is the so-called high-frequency trading markup. Some people again argue that this is good because for large orders, basically the high-frequency traders collect all the small pieces and then they bundle them, which provides liquidity and increases the speed of execution. but they charge some small fee for that. So whether this is good or bad, often this is really about how you value different things. Probably high frequency traders in that sense increase the speed of execution, but they also increase the price. So which one is more important to you? I don't know. It's hard to make a general statement about that. But yeah, they can create stress on the system, a lot of stress on the system, especially with this quote stuffing. So because they trade so much and they can enter so many quotes and so many trades in the system that at the end are never executed. So they put a lot of stress on the system because the number of orders or quotes that they enter into the system is much higher than the actual trades they are doing. And one potential consequence I will show you after the break is that markets can crash because of high frequency trading or strategies that high frequency traders do. And a good example of that is the so-called flash crash in 2010. But yeah, let's do the break first. 10 minutes break before we continue. Okay, so let us do the last part for today. So we are just talking about high frequency trading. Some potential consequences, yeah, as I just said. I mean, a lot of orders, but not a lot of them are actually executed. And this can put a lot of stress on the trading system, or on the trading platforms. And I want to show you one specific event that gained a lot of attention, and that also, like, that is 2010. So that was like the peak of high frequency trading. It was still kind of the Wild West. There was not a lot of regulation. They just enacted some regulation or some newer regulation. But regulators were still not very sure how to deal with these high frequency traders. Okay? So that is 2010, the so-called flash crash. So what happens? The day starts relatively quiet. But then suddenly the stock price starts to become a bit volatile here, so down a little bit. So this is May 6, 2010, down a little bit. Then the downward trend starts to become more severe, but it's still like within relatively normal limits. And then suddenly the market crashes. So the Dow intraday crashed by nearly 10%. So at this point, we are talking about a loss in market value, market cap of trillions of US dollars. Okay? So if you see a crash like this, I mean, probably, and I don't show you the date, I guess you would expect that something really significant happened on this day, right? I mean, I don't know. This could be something like 9/11, there is a lot of fundamental news coming to the market and the market immediately adjusting prices downwards. Or the crash of Lehman Brothers or something like that. Okay? The thing that nobody understood at that time was that nothing happened. There was no fundamental news coming to the market. There was not even a Fed meeting or nothing. No fundamental news. And still the market crashed by nearly 10%. And equally surprising to some extent is that the market recovered very quickly and then closed only 3% minus. So people were really trying to understand what happened, and it proved to be very complex. So there was an initial report by the SEC, the Security Exchange Commission, trying to understand what happened. They blamed some traders for that, but then other people say this initial report was not accurate. So honestly, to this date, we don't know exactly what happened, but we have a pretty good idea that a big part of this crash was actually played by him. He was a trader. He's called Navinder Sarao. He was a trader, and what he did was he used a spoofing tactic. Okay, so around that time here, he placed sell future orders. So he kind of in the E-mini future for the S&P. So he pretended that he wants to sell a lot. So kind of pretending that he thinks the market will go down a lot. So the mini futures were for 4.1 billion US dollars. So he placed these orders, and these orders signal to the market that he thinks the market's going down. Okay? The problem now is that actually not humans picked up this price signal, but computers picked up the price signal, and they were programmed to basically execute sell trades whenever they think that somebody bets on a market crash in that large. Okay? So what happened is that he placed these orders in the E-mini futures market. Computers, high-frequency traders, picked up that signal, and they started actually really selling, and that led to the crash. Okay? So then when the crash happened, what the SEC did, or the exchange regulator did, is actually they stopped trading in this E-mini futures for only 5 seconds. And then the market recovered. Because then the computer programs realized, oh, nobody's actually betting on a crash. That was just a mistake. And the computer programs basically reverted their trades. The thing that this crash really nicely illustrates is how complicated everything became, because nobody first understood why the program sold here and why they purchased again here. These are highly complex algorithms. It's not even their programmers really understand what they are doing, why. I mean, of course, they know which signals they are looking for, but why exactly they execute which trade, that's pretty complicated to determine. Okay? So it literally took years to fully understand what was happening. But again, what was most likely a key contributor to this crash, in addition to other things, was Mr. Sarao placing these orders in the E-mini future market without ever executing them. So he was spoofing the market. He placed the orders and immediately canceled them again. But the computers, the high-frequency traders, still picked them up and used them as signal. The market crashed, and actually he made a lot of money because previous to that he purchased put options on the Dow. So when the market crashes, he can execute his put options and make a lot of money. So, yeah, it turned out he used the same strategy. He's a smart guy. He used the same strategies before in other markets, but it never led to such huge market disruptions like the flash crash. So nobody was super interested in that. And he made a lot of money doing these previous trades. But this time, I mean, he would not have expected that his actions lead to a 10% crash in the Dow. He just wanted the Dow to crash a little bit and then basically hide his trades. Nobody realizes what he's doing. So he's an interesting guy. I mean, he's a London-based trader. He's still doing, there are stories that he did it from his bedroom. So basically, he only has a computer, and that's how he works. So over the years, he made roughly 70 million US dollars trading out of his bedroom. But at the same time, at least he claims that he lost all the money again. So around 2015, people realized his role in the flash crash. So it was 5 years after the flash crash that he was kind of identified as one of the main culprits, potentially. 5 years. That, again, illustrates how difficult it was for the regulators back then to really understand what's going on in the market. Then he was brought to court. His sentence was quite lenient. I mean, only 1 year of home detention. And he did not get any financial sentencing because he claims that he has no money left. So he claims he lost the 70 million in bad trades, and part of it was stolen. I don't know. He had a long story what happened to the 70 million. But also like this, remember this change in how trading works, and I think the last line, and that is actually from one of the interviews with him when he was sentenced to this home detention. He basically said that he viewed the markets as sophisticated video games. So the way he was trading, he was not really thinking about the money so much. He just wanted to beat the market like you try to beat your enemy in a video game. Okay, so that was really, according to the judge, I mean, that's why he received this relatively lenient sentence. His main motivation was not greed, but really kind of this, I want to beat the market in a video game style environment. Okay. And now you contrast that how markets worked in the 80s, I mean, it's a pretty different world. Okay. All right. Let's talk about short selling now. Short selling is another strategy to actually make money, to profit. But with short selling, you do not profit from increasing prices, you profit from falling prices. Okay? So the basic idea is very simple. In the easiest case, which is called the naked short selling, you simply sell something that you don't have. So naked short selling would allow me to sell you a share that I do not possess. So I have -1 share in my portfolio. Then I can keep the -1 share as my portfolio position for some time. But of course, after some time, I have to close my position. I buy +1 share from the market so that I have 0 shares again. Okay, so that's naked short selling. You profit from falling prices because if I sell the share now to you for 100 and I can purchase it from the market in 2 weeks for 80, then I made a profit of 20%. Okay? So the delta or the sensitivity for short selling is 1, or more precisely -1. Right? 10% increase in the stock price, naked short selling means 10% loss on your equity. 10% decrease in the stock price means a 10% gain in your equity. Sensitivity of -1. Okay? What are other strategies to speculate on falling equity prices? What else could you do? Like Mr. Sarau, he used put options. And you can use put options. You can use a lot of different derivatives. But short selling is basically the only mechanism that does not involve any kind of derivative or additional contract. So you actually really act on the equity market. If you use derivatives, you always have some additional contracts. So naked short selling is not always possible. What is actually more common nowadays is so-called covered short selling. If you do covered short selling, you are not simply selling a share that you do not have, but you first have to borrow the share from a broker. So basically, you are the short seller, you borrow the share from your broker, and then you sell the share on the market, then hopefully the share price declines, but even if the price does not decline, you have to buy the share again from the market, you return it to your broker, and then you close your position. Okay? So this is covered short selling. You borrow the share from a broker. Naked short selling, no shares, nothing borrowed. You really have 0 shares and you sell it. Okay. Good. How that exactly works, let me show you that with an example. Okay. Because there are, similar to buying on margins, there are some restrictions that are implemented. And the intention of all these restrictions is that your broker does not face risk. Your broker basically sets the rules so that the broker is isolated from all the riskiness. So how does the broker do that? I mean, this is what I want to show you with this example. There's again a margin. Let's say the initial margin is 50%. There's a maintenance margin of 30%. The initial price is 100, and we have 1,000 shares that we are short selling. Okay? So 1,000 shares times 100 gives us sale proceeds of 100,000. Okay? 100,000. What is the margin now? Well, the margin is the fraction of the value of the position that I have to additionally add with equity. So basically, if the sale proceeds is 100,000 and the margin is 50%, I have to additionally transfer 50% of that amount as a margin on my account. So what I have on my account now, at my brokerage account, are the 100,000 that I received from short selling, plus the 50,000, which are my initial margin, right? Okay? So without this initial margin, you would not need any equity, any money to do short selling, right? Because then you just do short selling, you receive the money from the one who buys the shares. There is no own money involved. In reality, you have to involve your own money because your broker will demand this margin. Okay? It's now important to realize that these 150K, they are on your brokerage account and you cannot simply withdraw them. They have to stay on your brokerage account. Okay? What they are is actually they are the collateral for your liability. And your liability is the liability to buy the shares that you own. Right? You short sold 1,000 shares, so now you have a position of minus 1,000 shares, so you owe 1,000 shares. And these assets are the collateral for this liability. If we would allow the short seller to withdraw this money, and the short seller would simply disappear, I mean, the broker would face a tremendous loss, right? Because you have minus 1,000 shares in your portfolio, so the broker cannot simply close your account. You have minus 1,000 shares. So the broker would need to buy the 1,000 shares so that your account can be closed. Okay? Or if you borrow the shares from the broker and you short sell them, you could just flee. You could just move to the Bahamas and you're never seen again. So then the broker would lose the 1,000 shares that belong to the broker. So that's why the broker always demands that these assets stay on your account as a collateral. Okay? So let's do the example here. So what happens? The share price falls to 70 per share. So what are your liabilities? Again, your liabilities is the amount you need to cover your position. So it's basically 1,000, which is the number of shares you short sold, times the share price. So the liabilities here are 70,000. Okay? So now let's say we close our position. So this is the, let's say this is the end. So then what are our assets? 150,000. We need 70,000 to close the position. So our equity is 150 minus 70. It's 80,000. So our ending equity is 80,000. We invested 50K at the beginning. So we made a profit of 30K. Okay, which is very simple. Simply the decline in share price times the number of shares. So it's very easy to calculate this gain or profit or loss. But if you look at it from this perspective, you kind of see what is actually going on your account. You have the assets and you have the liabilities and you have the equity. Is that clear? Okay. Sorry. So, how much can the stock price now rise before we receive a margin call? I mean, this is very similar conceptually to buying on margin. The problem is now, if you go back here, these are your assets, right? 150K. Your liabilities, this is what changes over time because this depends on the stock price. So let's say the stock price goes up to 150. If the stock price goes up to 150, your liabilities go up to 150,000. Right? And that would make your equity basically zero. And then if the stock price goes further up to 160, your liabilities would be 160,000 and your assets would only be 150,000. So now suddenly the broker would have a risk exposure. That's why we need the maintenance margin. If your equity becomes too small, your broker will send you a margin call so that you have to transfer new equity and your margin can go up again to isolate the broker from the risk. So how much can the stock price rise before you receive a margin call? Well, let's calculate the equity we have. This is 150 minus the liabilities, and the liabilities are the price times the 1,000, scaled by the liabilities. So how much of the liabilities are covered by equity? Okay, so and that has to be 30%. So if we set in the values here, it's 115.38. Okay. So if the stock price would rise above 115, you would receive a margin call and you would have to transfer new equity, otherwise the broker would close your account. Okay? Clear? So I think it's relatively simple. It's really conceptually in economic terms, it's very similar to buying on margin. So you do all this stuff to make sure that the broker never faces risk. And basically you always have to keep equity on your account so that the broker does not face risk. How exactly you calculate that? Yeah, it's very trivial. Okay? So, but these margin requirements actually play a pretty huge role. And this is closely related also to a phenomenon on the markets that is called a short squeeze. Short squeezes became quite popular because of GameStop, but I will show you that they happened also before that. Okay? So what is a short squeeze? Well, a short squeeze occurs if short sellers, for different reasons, suddenly have to close their positions. Okay? So if you're a short seller, you bet on falling prices, right? But it could be that you have to close your position, and one reason for that could be that the price of the stock goes up. Okay? So if the price goes up, your broker will send you margin calls. A broker will say, oh, your equity declined. The price went up, you need new equity. We need new equity. Then the price goes up further and further, so you have to transfer more and more equity. So at some point, it might be that you just cannot afford to transfer new equity and you have to close your position. So if the price goes up, more and more short sellers actually have to end their bet because they cannot afford the equity anymore. They cannot afford the margin calls. The problem here is that this is kind of a vicious circle because let's say the first short seller on a specific stock has to close the position, then this creates buying pressure on the stock. How do you close the position? You go to the market and buy. So that pushes the price up even further. So and then the next short seller cannot afford the margin calls anymore, so they also go to the market, they buy, pushing the price even further up. And that's really why you sometimes see this extremely strong upward pressure on a stock. Because a lot of short sellers, sequentially, or also at the same time basically, they have to close their positions, they rush to the market, and they buy the stock for basically whatever price. A second kind of complicating factor that is related to that is that sometimes short sellers realize that the number of outstanding shares, the number of free float shares, is too low to cover all the short positions. So there can easily be a kind of a panic among short sellers that they will not be able to cover their positions. And at the end of your bet, if you cannot cover your positions, it can really mean the default of your company. So you cannot sustain a negative position in a specific stock. Okay. So do short squeezes happen in reality? Yes, of course. So these are some of the more famous examples that I want to spend a few minutes on showing you. So this is one of the most famous ones. This is the Volkswagen case in Germany. This is one of the more recent ones. This is the GameStop case. And this is one of the earlier ones in the 1920s, Piggly Wiggly. Okay? But short squeezes happen all the time. So it happens quite frequently. So let's first talk about the Volkswagen case. So Volkswagen, for a short period of time in 2008, was the world's most valuable firm. So if I would have done this 10 most valuable firms that I showed you last week, for this 2008 period, Volkswagen would be number one. So the question is why? I mean, this is the price chart of Volkswagen in 2008. I mean, this is July, August, September, October. Actually, the price was somewhere 200, 400, a bit volatile, but suddenly the price shoots up to 1,000. So it really goes up from 200 to 1,000 within a trading day. So if you see something like that, again, typically you would expect that Volkswagen invented, I don't know, some great product, a car that needs no fuel or something. I mean, that would justify a dramatic increase in the stock price. Right? But nothing happened in that sense. There was no new product announced, nothing like that happened. The fundamentals of Volkswagen did not change. What happened is that there was a massive short squeeze. And the short squeeze came from two parallel events that occurred during 2008. The first one was that a lot of short sellers actually started to bet on falling Volkswagen prices, and they were taking short positions on Volkswagen here. So there was quite a bit of short interest on the Volkswagen stock, a lot of short sellers. That was the development one, or event one. At the same time, a second thing occurred. A company tried to take over Volkswagen. Anybody knows which company tried to take over Volkswagen? Porsche tried to take over Volkswagen, yes? They were very clever. They actually had a very high level of financial sophistication. They actually hired traders from all the investment banks to do that. They did not simply buy the shares of Volkswagen, because the problem if you buy the shares is that once you reach thresholds like 5, 10, 15%, you have to tell the market. You have to say, oh, market participants, we, Porsche, now hold 10% of Volkswagen. So the market's not stupid. They would realize, oh, these guys are trying to take over Volkswagen. That will push up prices. So a lot of investors will also buy Volkswagen share, push up prices, and make it much more expensive for Porsche to take over Volkswagen. They were much more clever than that. They actually they exploited a regulatory loophole, because in Germany at that time you were not required to tell the market your position in derivatives. So they did not buy the stocks. What they did is they purchased call options. So they purchased call options that gave them the right to purchase the stock, which is actually, if you execute them, it's the same, right? But so they had call options to purchase nearly the entire free float of Volkswagen. Okay, very clever. So they didn't tell the market over the whole 2008 when they built up the positions. Nobody knew. And then some nice day they said, oh, by the way, dear market, we are just taking over Porsche, Volkswagen, and by the way, it's too late. We already built up this huge derivative position so we can buy 51% of Volkswagen. Okay? And that was actually really the moment when sheer panic broke out with the short sellers, because they realized if Porsche executes these options, there is no more free float. There is no more shares. Because some of the shares, they are held by long-term investors like the German government or the German state in which Volkswagen is located. I mean, they will not sell to short sellers, no matter what the price is. So the whole free float was basically gone, they thought. So what's the natural reaction? Yeah, you rush to the market, you try to buy for whatever price, and that pushed the price up to 1,000. They really panicked. And then probably some didn't panic. But because some panicked, they pushed up the price. The ones that didn't panic so much, the short sellers, they received margin call after margin call here. And at some point, they just couldn't sustain their position. They had to close it. It became too expensive. So what's the end of the story? Did Porsche take over Volkswagen? No. What's the end? Yeah, but that's a kind of slightly different story, yes, but you're right. But at that time, people really thought Porsche would take over Volkswagen. But actually it didn't work out very well for Porsche because unluckily for Porsche, something else happened in the autumn of 2008, which was financial crisis, actually the collapse of Lehman Brothers. So after the collapse of Lehman, the credit markets completely froze and nobody wanted to lend money to Porsche. So they had all these call options, but they had no money to execute them. Because they had prearranged deals for loans with a lot of banks, but suddenly because of Lehman and because everyone was panicking, they said, oh sorry, we cannot give you money. So they had all these call options that they could not execute. So they were expiring without being executed. Porsche lost millions, billions nearly. So they were basically bankrupt because of that. And then Volkswagen took over Porsche. That was one of the most unsuccessful takeover attempts ever because within a few months it was actually the other way around. And now until today, Porsche is part of the Volkswagen group. Okay, but that's the background. And they were really very close to taking over Volkswagen. It was very clever and very close. Without the financial crisis, they would have taken over Volkswagen. Very likely. Okay, just to show you some of these stories. Piggly Wiggly is also an interesting case because it shows how much the market's changed. This guy is Clarence Saunders. He's the founder of Piggly Wiggly. Piggly Wiggly kind of created this modern type of supermarkets where people go in and have their own shopping cart and trolley and you take your own stuff. So this was like in the 1920s and this was very modern. So he actually invented that and it was his company. And then in the 1920s he became very angry. The reason why he became very angry is that some short sellers, he didn't like the bankers. So some short sellers on Wall Street, they dared to bet against his company. They were actually short selling Piggly Wiggly. That made him super furious, super angry. So what he did is he wanted to punish those bad short sellers. How can he punish them? He thought, well, he needs to make the stock price go up. So what he literally did, I mean, there are actually documentations of that. He went to the bank, took out a lot of money, put it in suitcases, took the train to New York, went to Wall Street with some of his partners, and then he started buying Piggly Wiggly stocks. That made the price go up and put a lot of pressure on the short sellers. So this is one of the more classical examples of a short squeeze that this guy really originated by taking all these cash suitcases and buying his own shares. And he nearly had the short sellers on their knees, so they actually lost. But then the New York Exchange Regulatory Commission, they actually rescued the short sellers because they introduced, for reasons that are to this date a bit obscure, they stopped trading on the Piggly Wiggly stock for 5 days. And that gave the short sellers enough time to cover their positions. Why exactly they did that and why they rescued the short sellers and made him basically bankrupt is still a bit unclear. So there might have been a bit of collusion between the Wall Street bankers and the guys running the New York Exchange. So here this is one of the reports of that. It's a fitting that the first major corner or short squeeze of the 1920 bull market began with the wreck of a businessman because he lost everything at the end. The avoidance of responsibility on the part of the exchange because it's totally unclear. There was no rule that allowed them to suspend trading. So why they did it is totally unclear. All in connection with a stock named after a pig. So this is the most famous short squeeze. I will not really talk about that a lot now. GameStop, you know all what happened. I mean, Reddit, Wall Street bets, a lot of small retail investors trying to take on bad Wall Street, bad short sellers. At least that was the narrative that was often framed. So stocks went up like crazy. Yeah, I think the story has been told many times. They lost a lot of money. So Melvin Capital at some point here, they had to close their position. Remember, GameStop stock started around 20 US dollars. So pushed up to 300. And at 300, Melvin actually, they said, we cannot take this anymore. They made so many losses. They received margin call after margin call. So basically their equity was not sufficient anymore and they had to close their position. Okay. So this created a lot of losses for the short sellers. So let me first show you the losses. So there were estimates that in 2020, actually 21, how much short sellers lost with specific stocks. And for GameStop, the estimates are somewhat around 13 billion US dollars. Only with this one stock. That is what short sellers lost. Okay. So to some degree, it's funny or interesting to see that the narrative behind GameStop and Piggly Wiggly is pretty similar. I mean, Saunders, the founder of Piggly Wiggly, he kind of justified that for himself by, oh, Wall Street is bad, those short sellers do something bad, so I have to beat the short sellers. And that was what often was also the narrative in this Reddit forum, so the bad short sellers, and they're betting against the prices, so we have to take them on, and something like that. So the basic narrative was kind of similar between Piggly Wiggly and GameStop. And here, like small retail investors taking on Wall Street, and in Piggly Wiggly case, a small founder of a supermarket chain fighting against Wall Street. So several similarities, actually. Yeah, this is the short interest in GameStop. So basically, this is the percentage of short sold shares relative to free float. So if that is 100%, it means you need every free float share to cover all short sold positions. Right? If that's 50%, it means, yeah, if all short positions are closed, we have still 50% of the free float left. If that goes above 100%, it means heavy short selling in the stock. So and then in the run up to the GameStop event, you could really see heavy short selling in GameStop. Very heavy short selling. And at some point it was 140%, meaning that really it was relatively easy probably to move the stock because short sellers easily panicked because they knew that the free float would not be sufficient to cover all their positions. Basically it's over short sold. Okay? So that surely contributed to the panic of the short sellers and why many of them, Melvin was relatively late, but others closed their positions much earlier, pushing prices up, this vicious circle thing. If some of them close it early in the event, I mean, the prices move up and then more close it, prices move up, move up, move up, move up, move up, more close it, move up. It's really a vicious circle. Okay. Good. We talk about short selling. Is that good or bad? I mean, after GameStop, many people have an opinion on that. Before GameStop, probably not so many. I think if you look at it more from an academic perspective, short selling has advantages and disadvantages, and it kind of depends on how you weight those different things, whether you think it's good or bad. Okay? There are possible advantages. First, short selling can increase liquidity, and the mechanism is pretty clear. I mean, imagine you think that prices are going down in the future. If short selling is allowed, I mean, what you will do is you will do short selling. Right? You participate in the market. you are active market participant in the equity market. If short selling is not allowed, it's more difficult, right? Because probably you can buy a put option. But the put option is not affecting the liquidity on the equity market. It's a derivative. It's a different market. So with short selling, there's probably more liquidity. It makes it easier for people to bet on falling prices. So probably we have faster price discovery. If prices are overpriced, and it's easier for people to bet on falling prices, probably we get a correction easier, sooner, faster, quicker. And that ultimately can reduce the risk of price bubbles. And the prime example that people typically use here is that the market that is most prone to price bubbles is the market in which it is super hard to do short selling or any other form of betting on falling prices. Which market am I talking about? In which market is it? It's basically impossible to bet on falling prices. Well, real estate. Real estate is very hard to bet on falling prices. And at the same time, the real estate market, or price bubbles in the real estate market, were the origin of many of the financial crises in the past 100 years. Because we often have price bubbles there. Probably because short selling is so difficult. I mean, how would you do short selling in the real estate market? It's impossible, right? I mean, they cannot tell you, you want to buy an apartment. Look, I actually don't have the apartment, but I'm still selling it to you, so I have -1 apartment in my portfolio, and sometimes in the future I give it to you. I mean, that's just not how this market works. Right? And also, there is no real put option market, and it's very difficult. Probably the best you can do is to find some equities that are closely related to the value development and bet on their falling prices, but that's very indirect. Yeah, there are possible disadvantages. I mean, some people find it unethical to bet on falling prices. I mean, that's more of an ethical discussion, I think. More economically, short selling can put pressure on already falling prices, and in that sense convert like stock market adjustments, small declines into crashes, which would be bad. So all of that is not totally clear. There are pros and cons. A little bit of the evidence we have is that liquidity seems to be negatively affected by short selling bans. So what this paper, Weber and Pagano, what they actually do is they look at short selling bans around the financial crisis. And then they look at blue, the bid-ask spread of stocks that were, for which short selling was banned. And the red are stocks for which short selling was not banned. And then they calculate the difference in the bid-ask spread. And what they find is that for stocks for which short selling was banned, actually their bid-ask spread went up, indicating lower liquidity in these stocks. So this is some of the evidence we have, but it's a bit limited. But probably short selling is good for liquidity. That's the takeaway here. Yeah, what you see all the time is when there is a crisis, when there is a stock market crash, regulators react with banning short selling. So short selling bans are very common. This is from the financial crisis. Basically, most countries around the globe banned short selling. Germany, Australia, US, UK, most of them did. In the aftermath, it became clear that this probably was not such a great idea. So this is an interview, a very famous quote of Christopher Cox, who was the chairman of the Security Exchange Commission, the SEC, during the time of the financial crisis. So he said, knowing what we know now, I believe on balance the Commission would not do it again, banning short selling. The costs of the short selling ban appear to outweigh the benefits, which is pretty much in line with the evidence in this paper, Weber and Pagano 2013, who also show that short selling bans basically didn't really help to prevent crashes. They didn't support prices. They mostly had bad unintended consequences, like reducing liquidity. Okay? So shortly after the financial crisis, people thought, yeah, well, maybe now we will not have bans anymore because that's what Christopher Cox said, that's what we know from research, so short selling seems to be okay, and short selling bans seem to be not too helpful. But ever since the financial crisis, whenever we had a new crisis or a new stock market crash, most regulators again react with banning short selling. So it seems like an automatic response when there is a larger crash, regulators ban short selling. The economic foundation of that is very weak, but they do it. So this happened like when the Greece debt crisis, this was around the COVID time, here 2020, short selling bans, and this is very recently, October 22, there was a stock market crash in Taiwan, and at that point also the Taiwanese regulators banned short selling. Okay. So pros and cons, regulation of short selling is really a very interesting topic if you are interested in like bigger picture finance topics, especially because it's so, especially because there are pros and cons, and it's not always totally clear which one is higher. From what we know now, it seems the cons are more important than the pros. The pros are more important than the cons, so we shouldn't ban it, but it's still often banned. Okay. All right. Thank you very much for your attention, and I see you next week. One second.